Atsi Sheth, the economist with Moody's Investor Services, joining us on the phone line from New York. Atsi, thanks a lot for joining us and thanks for staying up every once in a way for us. Let me start with what should be easy. Do you think the currency, Indian rupee, is past its worst in terms of problems, or do you think the rupee is still vulnerable?
The currency's depreciation had two causes. One was India's own current account deficit, which had been widening steadily over the last couple of years. That widening seems to have reversed over the last couple of months. So I think that aspect, the rise in gold imports and the oil imports that had driven up the current account deficit, that seems to have alleviated a little bit, which will provide some support. However, the other aspect of currency depreciation, which is fears around tapering and any other global risk aversion that could arise, that of course is unpredictable and that could arise from time to time. So I do think that you will see some rupee volatility, but on the flip side, at least the domestic aspect of that volatility is somewhat reversed.
So what are you working with in terms of a current account deficit for the current year? Do you think the problem is under control for a goodish bit, or just under control for this year?
We have a fairly conservative estimate. So we estimate that the current account deficit, which was about 4.8% last year, will come down to about 4%. And I do believe the consensus is that it will improve even more. At this point, we don't think we have the visibility to say that. So we're saying 4% this year. And then next year, that's FY14 you'd ask, I think it depends on two things. One is the global export recovery, which seems to be incipient. If that's I think India's current account the deficit will benefit. And two is oil prices. If they remain at current levels or even fall from current levels, the deficit should go down even further from 4% closer to the 3% mark.
Okay, that's the pleasant side of the story. Incidentally, Dr. Rangarajan told us 3% earlier today. His estimate is 55 million. Let me come to the other issue, which is perhaps so stubborn, the inflation number. What is the trajectory you are charting for inflation, both CPI and WPI?
Lata, we said a long time ago, about several months ago, that, in our view, inflation is really a key negative credit driver at this point in India's economy, and that's for a couple of reasons. First, of course, it has an impact on purchasing power for consumers, whether they're rural or urban. It has an impact on input costs for producers, so it does slow down domestic demand. It also, because of high inflation, of course, keeps interest rates high, as you've seen. So that's another factor that keeps domestic growth down. And thirdly, what we've seen, and this is coming to light more and more in recent months, is that when you have high inflation, of course, it inhibits savings because the value of your savings goes down. And for India, the high savings rate had been a key source of credit support. And as of now, India's savings rate really remains higher than its globally rated peers. But if inflation continues at this pace, I think it would have a detrimental effect on savings as well. So both from the growth side as well as from the savings side, I think inflation could do a lot of damage. I do think that the way to address inflation the world over has been monetary policy, and we're seeing that happening in India. However, on the other side, food inflation, which is really the key driver, monetary policy can't really address it. Maybe the fact that the drought is now behind India will have a beneficial effect. But really, over the long term, India remains very vulnerable to food inflation recurring from time to time. And from our perspective, that is a key negative.
Hi, Atsi. Good afternoon. Shifting focus then to fiscal deficit, what would your forecast be? And do you think enough is being done?
In terms of the fiscal deficit, we do think that it will come in around 5%. That's the central government's deficit that I think you're focused on. And the general government deficit, which we focused on, we think will come in closer to 8% of GDP. So that's a fairly high number. We've always believed that the fiscal deficit really depends on growth. The Indian government does not have that much flexibility to cut its expenditures, both because of the nature of the way those expenditures are organized, and of course because of India's political economy, that there's a lot of social pressure that supports certain expenditures, and those are hard to cut down. So given that, we believe it's the revenue trajectory that determines where the fiscal deficit goes, and since growth has been decelerating over the last 3 years, you've seen the effect on revenues. We think you'll continue to see that effect on revenues. There's very little that fiscal policy can do about revenue growth at this point. So I think that, what can be done is a cut down in capital expenditures, and that is exactly what the government has been doing over the last couple of years. And we expect that that will be the way in which the deficit will be managed. As to your second point, is loose fiscal policy something that feeds inflation? Over the medium term, yes, it certainly is, because what looser fiscal policy does is it supports demand growth, but does very little to support supply growth that should feed that demand, and as a result, the gap between demand and supply widens, and you have inflation. But this, again, I don't think is something, excuse me, that began in the last couple of years. I think this has been ongoing for several years, and therefore will take several years to fix the impact of fiscal policy.
What about growth then, Atsi? What would your forecast be for the current year and the next one?
We have always anticipated a very slow recovery. So even though you're seeing the numbers now improve, they're improving on a very low base. At the same time, the recovery is certainly in no way V-shaped. It's very modest at this point. So we expect the growth will be around 4.5% this year, real GDP growth, and then inch up to 5% next year. Our forecasts are a little bit conservative for this year and next because we do think there are two big uncertainties that we don't have visibility about. One specific to India, of course, is the election and policies that could occur before and after the election. And then globally as well, there's global growth, which seems to be improving, but we don't know how far and how fast it will improve. So those are the two things that give us pause, our forecast.
Fair point. Let me come to what your company does best, rating. Is there a rating downgrade anywhere on your radar?
We maintain a stable outlook on the rating at this point. And the things that we're watching, one of the reasons that India has a stable outlook on its rating is the structure of its government's debt. Because after all, a rating is a comment on debt repayment, creditworthiness of the government on growth. And the government's debt is in rupees. It's long-term in nature, and it's funded domestically. So that means that the currency volatility doesn't affect it
actually,
much.
Actually, Atsi, in that context, you spoke about domestic funding of Indian debt as a positive. But now the Indian government is trying to get Indian bonds listed in global indices. That means more foreign debt. Would you view that as negative?
I think that the base is small enough, Lata, at this point, that the net delta, the increase in non-resident purchases of Indian government debt, would still leave India mostly funding itself via residents. So I think even with the lift, that's a good question, I think. But even when that does occur, the increase would still leave the government funding itself largely domestically.
Okay, that's positive and sure music to the ears of the government, Atsi Sheth. We appreciate you taking time out for us. That's a key takeaway, isn't it? Even if foreign debt increases, when we get into global indices, it would still not mean a very high foreign debt. So at least rating agencies won't bother. Take a break on